Welcome, our dear viewers. Millions of people use mutual funds to help meet their financial goals, but you may not know exactly what they are or how to start investing in them. Like many financial products, they can be intimidating at first, but mutual funds are fairly simple to understand with a little help. In today's video, we will help you understand what mutual funds are and what the best way to invest in them is. Before we get into the video, don't forget that there's a bonus fact for you towards the end of the video. Number 1. What is a mutual fund? A mutual fund is a pool of money collected from investors that is then invested in securities such as stocks or bonds. Each share in the fund represents a proportional interest in the fund's portfolio. So, the more shares you own, the larger your interest in the fund. If a fund holds 5% of its portfolio in Apple and 2% in Tesla, for example, your share of the fund will hold the same stocks in the same proportions. There are thousands of mutual funds that allow you to invest in a variety of ways. You can find funds that invest in a diversified group of large companies, small companies, specific geographies, or even certain sectors of the economy. Number 2. Investing in mutual funds. Mutual funds can make sense for lots of different people at different points in their investing lives. But it's important to remember that it's not about the mutual fund itself, but rather what goes into the mutual fund that will determine whether the investment makes sense for you. These funds can hold assets like bonds, stocks, commodities, or a combination of several asset classes. You'll want to do your research before investing in a fund and make sure you understand the risk of the fund's underlying assets. Mutual funds are good options for both beginners and more experienced investors alike. Both types of investors will benefit from the diversification benefits of mutual funds, and experienced investors can find funds that target specific areas they think are poised for growth. One of the biggest distinctions between different mutual funds is whether they pursue an active or passive investment strategy. The difference will determine how the fund invests and can ultimately have a big impact on the returns you earn as an investor. Number 3. Active mutual funds. Active funds are managed by professional investors with the goal of outperforming a market index, such as the S&P 500 index. For an active stock fund, the fund manager and a team of analysts will work to identify which stocks to own and in what quantities to achieve the best returns. Similarly, active bond funds will attempt to beat bond indices through superior management. But it's not as easy as it looks, and actively managed funds often fail to match the performance of the index they're trying to beat in the first place. On top of that, active funds come with larger fees to pay for the professional management. So the returns to investors are lowered further through the types of costs. Number 4. Passive mutual funds. Passive mutual funds are managed to track the performance of a market index. They do not require an expensive investment team to manage the portfolio because they aren't trying to identify the best performers. They're just trying to match the index. This allows passive funds to charge very low fees and sometimes no fees at all, which leaves more of the return for the fund's investors. Passive funds may sound simple and even a little boring, but they have consistently beaten actively managed funds over long time periods. There will always be a few active funds that outperform their benchmark over short time periods, but very few will do so consistently over the long term. Number 5. Types of mutual funds. There are many different mutual funds available to investors, and it can be confusing to inexperienced investors to navigate them all. Let's take a look at some of the more popular types of funds. Number 1. Stock funds. These funds invest in corporate stocks, but can also pursue different strategies from fund to fund. Some funds focus on companies that pay dividends and are well established, while others are more focused on growth and the potential for price appreciation. Still, others are focused on specific industries, sectors, or geographies. Number 2. Bond funds. These funds invest in various forms of debt, and their risk profiles can vary widely from fund to fund. Some will invest in relatively safe bonds issued by governments, while others invest in so-called junk bonds that offer higher potential returns. Be sure to read the prospectus before investing to make sure you understand the risks being taken. Number 3. Money market funds. These funds tend to be low risk and earn a small return above that of a normal savings account. Money market funds invest in high-quality short-term debt issued by companies and governments. Number 4. Index funds. These funds have surged in popularity in recent years due to their simplicity and low-cost structure. Index funds track the performance of an index such as the S&P 500 and are usually able to keep costs low. Studies have shown this passive approach outperforms active management over long time periods in most cases. Number 6. How to choose a mutual fund. Choosing which fund to invest in can be intimidating when you look at all the different options. The first thing to consider is whether a fund's investment objectives are aligned with your long-term financial plan. For beginning investors who are early in their careers, investing in a low-cost S&P 500 indexed fund is likely to be an attractive option. Ultimately, a fund's performance is what will matter to you as an investor, so try to understand the drivers of a fund's long-term performance and whether that is likely to continue in the future. You'll also want to consider the fees associated with purchasing shares in a fund. Remember that if two funds have the same investment performance, the one with the lower fees will leave their investors better off. Number 7. How to buy mutual funds. Mutual funds can be purchased through online brokers or through the fund manager themselves, but there are some differences between the way mutual funds trade and the way a stock or ETF trades. Mutual funds are priced at the end of each trading day based on their net asset value or NAV. The NAV is calculated by adding up the value of the fund's holdings, subtracting expenses, and dividing by the number of shares outstanding. When making a purchase, you'll receive the next NAV, so if you place an order after the market has closed, you will receive the next day's closing NAV as your price. Most mutual funds have a minimum investment of a few $1,000s, and you can choose to buy a certain dollar amount of a fund or a specific number of shares. Number 8. How to sell mutual funds. Mutual funds are sold similarly to the way they are bought. Using an online broker or the fund's manager, you'll place a sell order and will receive the next available NAV as your price. Since mutual funds don't trade throughout the day like stocks or ETFs, you won't know the price you're selling at until the trade goes through. Mutual funds sometimes have fees for selling the fund in a short period of time and are therefore not ideal for short-term trading. They're best used as vehicles for long-term investments and are commonly held in retirement accounts or invested towards another long-term goal. Thank you for patiently waiting, and now let's get into today's bonus fact. When investing in mutual funds, you need to watch out for the fees. One of the most important things to be aware of when investing in mutual funds is the fee you'll be paying. You can find this information in the fund's prospectus, and while it may not sound like much, costs really add up over time. What do you think about mutual funds as a source of investment? Let us know in the comments section below if you think this is something you could get behind. We have more videos like this coming up soon, so like, comment, and of course, subscribe to be the first to be notified of our newest content, and we will see you all soon. Bye!